So if you plant a seed and, wait a decade, you get an apple tree. But the markets we're looking at today in your sources, they basically take a chainsaw to that tree.
Yeah, absolutely.
Right, we are looking at crypto and Forex, where,
Mm.
honestly, you can lose the whole orchard before breakfast. So our mission today is to cut through that get-rich-quick hype and look at how contracts for difference actually work under the hood. Because the real secret to surviving here is not making money, it is managing risk.
I mean, that is exactly it. Because if you don't understand the mechanics of these contracts, you're honestly just gambling.
Yeah.
You are stepping into this crazy environment where global currencies trade around the clock and, digital assets never sleep.
Right. And what really stands out in the sources is that these traders, they aren't hoarding physical euros or like moving Bitcoin into cold storage or hardware wallets. They are trading CFDs, which means contracts for difference. But what is that actual mechanism? Like, how do you trade Bitcoin without ever actually touching Bitcoin?
Well, it's actually pretty straightforward. You and your broker are essentially making an agreement to exchange just the mathematical difference in price of an asset from the exact moment you open the contract to the moment you close it.
Okay, wait. So if I go long on Bitcoin at, say, $60,000 and then I close it at 61,000.
Then the broker pays that $1,000 difference directly into your account.
I see. And if it drops to 59,000, then I owe the broker a grand. I'm just trading the price spread.
Exactly, yeah.
So if I short a pair, like the euro to US dollar, I'm just taking the other side of that same contract. I profit if the euro drops against the dollar. It is honestly like placing a wager with a casino on whether a specific racehorse will beat a track time rather than going through the hassle of, actually buying and feeding and racing the horse yourself.
That is a great analogy. And the crucial factor in that wager is basically the track condition. Your sources draw a really hard line between trading major pairs and exotics.
Right, the majors versus exotics.
Yeah. So if you trade euro to US dollar, you have massive deep liquidity. Millions of institutions are trading it, so the price moves relatively smoothly. But if you switch to an exotic pair, like the US dollar against the Turkish lira,
The liquidity just dries up.
completely dries up. The CFD mechanics are identical, but because fewer people are trading it, the price can gap wildly. It makes it a much, much more hostile environment.
Wow, okay. But since you never have to actually buy the underlying asset in any of these environments, you can use leverage. But I want to challenge the math in your sources for a second here.
Oh, sure, go ahead.
Because they really hammer on this rule to never risk more than 1% of your equity per trade. But like, if you're listening to this and you have a starter account of just 500 bucks, risking $5 a trade means it will literally take decades to see real profit. I mean, why wouldn't you just max out your leverage to make the time investment actually worth it?
Well, that's the classic trap, right? Because leverage doesn't just multiply your buying power. It severely compresses your margin for error, basically down to zero.
How do you mean?
So let's say you use 100-to-1 leverage on that $500. You now control a $50,000 market position. But a microscopic 1% price move against you doesn't just cost you $5 anymore.
Right. It costs 500. So my entire account gets completely wiped out in a single blip.
Exactly. And the broker automatically liquidates your position the absolute second your losses exceed your deposited margin.
Oh, wow. So you don't even get a chance to wait for the market to recover.
Nope, you're just out. The math that allows you to control those massive positions is the exact same math that forces you out of the market instantly.
Man. Which I guess brings us to the psychological survival tactics in your sources. And the most critical mechanical tool here seems to be the stop loss. But how does that actually protect you when the market is moving that fast?
So mechanically, a stop loss is just a pending order you set with your broker. You define a specific price level before you ever even enter the trade. And if the market hits that level, your trading interface, so whether that is standard industry software like MT4 or MT5, or maybe a broker-specific platform like Monaxa, it automatically fires off a market order to close the position.
Got it. So it takes the decision entirely out of your hands.
Exactly. Completely out of your hands.
Which is key, right? Because the notes point out some just brutal psychological traps. There is revenge trading, trying to instantly win back that $500 you just lost.
Oh, yeah. Revenge trading destroys accounts.
And then there's the ultimate cardinal sin, which is physically dragging your stop-loss line further away on your screen as a trade goes against you.
Yeah, moving a stop loss basically invalidates the original risk parameter you set when your head was actually clear. You are letting panic dictate your strategy.
Right, so you're transforming a small, mathematically expected loss into a totally catastrophic one.
which is exactly why the sources heavily suggest starting in a simulated demo environment. The money is fake, obviously, but you can train yourself to respect the mechanics of the stop loss.
You are essentially training yourself to lose gracefully. It shows that navigating CFDs and Forex isn't about predicting the future with some magic crystal ball. It is a highly disciplined performance skill.
I completely agree. The traders who actually last long-term are the ones who obsess over risk, not reward.
You're just building a system to survive your own human nature when you're inevitably wrong. Which really leaves you with a fascinating question to chew on as we wrap up.
Definitely.
If surviving these high-velocity markets requires this much brutal emotional discipline and mechanical risk control, well, what does your own personal appetite for financial risk reveal about how you handle uncertainty in your everyday life?